we have really, the opportunity to look at some Wyckoff work by our friend Bruce Fraser. Bruce, welcome back to Face. I always look forward to talking to you and seeing what your point and figure stuff is doing. And welcome back. Hope things have been going okay for you, buddy.
Dale, great commentary
Bruce,
this morning. It was great. So, hi to
thank you,
Ryan,
man.
hi to Blake.
Hi, Bruce. Good to see you,
Hi,
man.
Bruce.
Hey, great. Uh, I I never know what you guys are going to talk about, and so I just have a big pile of stuff here. And but I try to create some perspective that is maybe a little bit different, but on the same topics. And so
Okay.
hopefully I can accomplish that today a little bit in the time that we have.
You
And
usually do, Bruce. So
ah,
I mean, I am able to pick out some ideas from some of the things you say every time you're here. So here we go. Where you want to start with the
I'm
dollar
just
ETF?
I'm just shocked that you even invited me back. So it's
Oh,
like,
come on.
what the heck? Anyway, so now I don't trade the currencies, but I do pay attention to some surrogates. UUP is a surrogate, and I do that because I can do point and figure on it. And just this particular chart, very big time frame. In this case, it's a 60-minute chart. But what I really want you to see here is this classic Wyckoff distribution structure. And it's really beautiful. It has an upthrusting action after forming a buying climax, series of secondary tests, and upthrust at the conclusion of the distribution. Then look at this outright failure.
Yeah.
And this failure all occurs, which tells you that this is an upthrust after distribution.
Yeah, that
And
was a CPI. That was a very ugly day.
oh my God. And so, and then a rally of very poor quality that goes into the area of resistance and then just an outright failure.
Well,
So
maybe
now,
that was a CPI.
and
I'm not sure
so
which series of O's, but it was one day that, really just cracked the back of the dollar.
they
And it
were
was,
oh no's. Oh, they
yeah.
were oh no
Oh,
O's.
no.
and so
Yeah.
notice here how you're getting this attempt to consolidate and rally below this critical resistance at 29.65.
Yeah.
And so it wouldn't surprise me, even as Blake had pointed out, that there could be more rally coming in the dollar, but from a position of vulnerability. And so we take a distributional count of this structure, and it takes us all the way back down to the area of the June lows for the dollar. Now, this is in UUP. And so we'll just have to watch to see whether or not it can rally. And then if it then fails back into this we would call redistribution and could keep going down with some more oh no's. I'm going to use that. Anyway.
Yeah, I like it.
But
what are you going to use for X? X-ray vision?
Yeah, right. That's it.
All
yeah,
right.
it's a good thing.
Yeah.
So, just taking a minute to look at the stock market, the S&Ps, because you were all talking about it. So we basically started to see the evidence of stopping action back in June of 22. We call this preliminary support selling climax. We've actually met and talked about this in the past, this very chart, Dale. And this chart's a big mess, but it's really my notes. And so I just keep publishing it all the time, and I just keep, adding notes to it as we go. And we started doing this back in the distributional top back in late 21. And also I'd point out, because you all were talking about the end of the year, and I'd like to point out that the bull market top struck right at the end of 2021. And so this was, Blake called it FOMOing. So here's another example of FOMOing, which is very good. And so, and then down we go. But we built this beautiful accumulation structure, and we've done point and figure work on this. We had a beautiful swing trade in June of 22, another one in October, November of 22. and then completed the accumulation, and up we've gone since, even more dramatically in the NDX. But what I really wanted to show you down here is this breadth indicator, which is the percent of New York stocks above their 50-day moving average. And a beautiful base back in October. And this is actually what we would call a divergent condition, because look at the lower lows that we got into key support here in late October, unconfirmed by this breadth indicator, which did not follow the market lower. That's pretty darn bullish. Similar thing occurred a year ago, October, and it created a nice rally phase thereafter. And we've had a really good rally since. We're back up to the resistance of the July high. But now we're starting to get into the resistance of the bull market peak. And so this, I think, is going to be very interesting to deal with. And I've got some point and figure work that might help us with figuring out about the how high this market could potentially go.
Okay.
But anyway, we're overbought here, Dale.
Yeah.
But what I look for is I look for a set of conditions: overbought and building some kind of a stalling type action or topping action, and then a reversal into a downtrend, even just emerging. And that downward stride from an overbought condition would be the thing that would really indicate to me that we have a reversal of trend. So until we get that, we could stay overbought up here and continue to be overbought into next year. And so we don't want to get ahead of the trend per se.
Could we get a pullback to 4,300, Bruce, and then make a new high, and then look for breadth divergence if the market like makes new all-time highs after pulling back, say, to 43?
No question, we could do that. Absolutely.
Okay.
And so, and I never know where Dale wants to go. So let's just go back here. This is a chart I've shown you in the past. You'll note here, this is actually October of 22, making the case we traded this swing trade. Here's the October low, traded this up to the resistance area and said, oh, we're going to build a larger cause and we're going to pull back again. And this count could be even bigger. And this is in fact what happened. We did just that. We rallied up into here. We pulled back again. Look at these counts though. Now we have these, what I call segmented counts. And this one here took us above the highs of August of 22. And then this count, which is this whole area across here, look where it counts to. Counts as high as, 65.50. So but some things need to happen. We need to get above this resistance area, and this can take time. We can use point and figure to estimate extent, but we can't estimate time. And so here is another chart. It's this, now this is the 1920 reaccumulation, and look at how beautifully it struck the highs here. And but here is really more of what I'm interested in looking at. This is what we just looked at, but a cleaner picture that I just recently made, 3-box reversal 50-point scale. And this count across here is the one we just looked at. And this count takes us up to, look, it confirms basically the count that we just looked at on the prior chart. And so now we have two really interesting confirming counts that go up to new all-time highs. And so I think that's a reason to continue to stay oriented towards the bullish side, with the caveat that we have a lot of work to do to get through this area. But I have some other perspective here about what could happen in the year ahead, which could help us. And so, but where would you like to go? You want to talk a minute about interest rates, or?
Sure. Last week was a big week in gold, and a lot of people are following gold, Bruce, and that was one heck of a reversal after making new all-time highs in Asia and then putting in a big reversal. So
yeah, and I didn't And I apologize, I did not put in a chart of gold itself.
Okay.
These are the miners. GDX is a surrogate. And
Okay.
so this count, now this goes back to November, but this count here, you can see we're making the beginning of a swing count with a hinge forming. And then here,
still bullish.
and you could see here, this is through Friday. And this count takes us 40 to 45, a bigger accumulation structure. It's kind of a beauty. And this count confirms that count, which is a very good thing too. And this counts up to 41. But I just wanted to point out that it's kind of a critical juncture because we've jumped above this 30 resistance area and then pulled back, and this is through Friday. And so we pulled back to this $30 level. And I think it pretty much needs to hold right around this zone, because if we start to fall to 29, even 28, we're falling back into the structure. May mean a bigger count, but it could mean that this is just redistribution for another decline. So we need to stall here and start to rally back above this 30 level, 31 level ASAP. And
we got to almost 32. I don't know, your X doesn't show it. I think the high was 31.90 or something like that.
It would have to have actually just touched 32, and then we would have got another.
So you don't get the X if it touches it but doesn't close there. So
exactly. Yes.
Okay, got it. Yeah, rates are important. Okay, let's see silver here. That too, silver, also.
Another swing count. And here we have a big structure, but again, same issue. We have a nice accumulation structure here, and we have a swing count here, which goes to 35, gets slightly above the resistance level, but it needs to be able to stall in this area where there's minor support and then start to turn up again and to get going. And I completely, and this is actually 43, not 53. So I have to change that. 43, 44. But I completely agree with the analysis that you and Blake offered, which was that, gold had a really bad week last week. That was a big, nasty bar, which took it right down to support. And it needs to just stop and stop in the area of this key support. But that's more of a hope than it is an analysis for I
hear you, for people that are sat long through it. Rates, you brought up going to rates. It's important. I mean, we have all these central banks, as the guys talked about today, and TLT had one heck of a rally from 92 up to 96. So I'm thinking that we're going to stall up here and pull back towards 87, but you have the Fed funds up here. That's fine.
And I've got a couple of charts that speak to what you're talking about, but I thought for perspective, it might be good to go back and look at the 2-year yield, Treasury 2-year yield and the Fed rate together. And so you can see that what happens is that the 2-year with the red line is really setting policy, and then the Fed follows, and then the Fed finally catches up with the yield on the 2-year, like here and here. And this is the top of a bull market. So this is the S&P down here, and this is arithmetic scale, and that's why it looks so crazy. But here you can see that finally the Fed gets the Fed rate above the 2-year and then holds it there for a year. And then when rates start to fall, and this is really the point I want to make, is that when rates start to fall as determined by, say, the 2-year, is that good news or bad news? Because my experience, and we do a workshop on the business cycle and investing and trading through the business cycle. Joe Turner and I, my old business partner, and we're going to do another one in February. But when it starts to fall, this has normally been associated with recession. And so I think all these people that are looking for rates to go down might want to be careful what they wish for, because if rates start to go down, it could be just because the general economy is weakening. And you can see that that is the case here. That's the case here. That was the case here. And now look what's happening. So the Fed rate is through November 1, but this 2-year rate is pretty much up to date. You can see it's turning down. And so something, a point of caution, that if this starts to go down in earnest, then it could be a sign that we're having a turn into a slowing economy. So now
yeah,
go ahead.
Go ahead, Bruce, finish it up. I just wanted to ask you if you saw on your work with what you just said, with rates turning down, Jeremy Grantham says that the market, when that happens, doesn't bottom for another 6 months after the Fed starts cutting rates. Does your work back that up?
Yeah. As a matter of fact, if you look here, you can see rates start to fall here, and then you get down to this area. Well, look at where the Fed rate finally bottoms, and it's long after the stock market starts to go up. But look how long the interest rates fall with a falling stock market.
Yeah.
And this
that's
is terrible,
years.
Bear.
Yeah,
Exactly.
that's years. That's not 6 months. That's,
No,
3 years.
exactly. And this period here had a lot of volatility in it, and you have rates falling. This was Powell's, I think, first big, policy moment was when
in December, after he raised rates, where he held
look at how
hands with
much the
Yellen and
2-year went up
Bernanke.
there, and the volatility just took off.
Okay.
So, and then here's the COVID decline right here.
Okay.
So, so this is the 2-year on the left, point and figure, daily data, 3-box method, but I'm using ATR to scale this. And this is the count that I had off this basing structure here. Look at this nice little shakeout low, and then it just turns up really hard. And we had basically said we could go 510 to 5.325. And this is in fact what we did. We went to 515 into the zone of our count. But then look at how hard it's failed. These rates have fallen. And of course, we've all experienced that recently with the reversal in rates. And I'm sort of the mind that this is a place where, as you all were saying, where rates find a low and attempt to rally. So I think we could be range bound for a while in here. Okay. And but if we just keep melting down from this level, I think it could very well be a sign that the economy is softening somewhat. Here's the 5-year. You can see here's our accumulation structure and yields, and it goes up, throws over the top of this area, and then you can see if I take this whole bigger count, this counts 462 to 504. We went right up to 490 and struck the middle of this count objective range. And so we fulfilled these counts. And then here is the 10-year. And the 10-year, you can see just a very big base. And this count here, 430, 470, but then we have a bigger count, 480, 520. Here's what subsequently happened. We went to 490 and then reversed really hard. So we fulfilled counts on rates, and this is how I watch the Fed. I just do my point and figure work, and these counts were beautiful. They came early in the year, and in beautiful stride upward.
What would it take for the count to shift back up towards higher? Even if like we had this little bounce in 10 years, like to 460 and then went to 370, do you think this is the final high yield, or just maybe a cycle within the secular
Well, this is, yeah,
bull
and
market.
I didn't bring any long-term work on the bond market, and I do point figure on prices too, but there's no reason, Dale, that we just couldn't stay in this big trading range
Okay.
and for a period of time. And actually, as convoluted as that sounds, I think that would be maybe our best outcome, because I don't think I think the Fed's can be very reluctant to cut rates. I know there's a lot of desire or wish for that, but
yeah, everyone's dreaming of the old days and having the Fed put again.
yeah,
and they haven't even needed it, really.
No, and exactly. And here is kind of an interesting twist on our discussion, because look at what we have here is we have the SPY which is the S&P ETF to the TLT 20-year treasuries. And basically it's a relative strength chart, point figure study on relative strength. And so you can see these beautiful little structures give these nice counts. Hit this one right on. This little count here counted up to this area. This count went to here. And now this count across this area went right up to the highs. Now look at this beautiful classic distribution. Looks very similar to what we saw in the UUP. So we see this big distribution structure, and then the oh no's and the uh-ohs, and down it goes. And this is a big breakdown in the relative strength. Now, what this means to, and everybody's already figured this out, but this downward stride means that bonds are now outperforming the S&P 500. Right. And how far down could it go? We just
that hasn't happened in a while. Look at how long,
Exactly. Yes.
Yeah.
And so normally the stock market in recent years has outperformed the bond market. And now all of a sudden the bonds are the asset class that's outperforming and could become the asset class of choice, especially if we get a slowing economy. And then let's see, is this the no, this isn't.
So that would say basically buy dips in the bond market, sell strength in the stock market.
Right. And I had a chart of the here it is right here. I didn't have time to do the counts, but this is the triple Qs, is the growth stocks relative to TLT. And so I put the vertical here so you could see this, but look, the beautiful distribution structure. So now we have, of all things, the growth stocks have been forming distribution against long-term treasury bonds, TLT. And here is our point and figure chart of this. We can count all the way across this area, which I have not done yet, but you could see that this is going to count down here into this zone at least. So how about that? The idea that the bonds could outperform the mega cap Magnificent Seven. Yeah. And so very interesting situation there.
Well, you outdid yourself again, Bruce, every time.
Well,
I'm really some really nice looks and analysis. Elite. I would give it the E word. Elite analysis.
Dale, you treat me too well. And but I always just love to hang.
It's so hard to get people to come back. I have to, really, butter them up.
Yeah, I have.
But I'm not patronizing you, Bruce. Your work is really top shelf. So
well, Dale and I are both very old school Dean Witter guys, and so we love hanging out and lying to each other.
Yeah, well, they had a branch office in Sears, and I couldn't sell stock, so I sold the washing machine.
Yeah, now there's no more Sears.
Yeah, there's no more a lot of things. No more Pac-12. I can't believe that. That's like the end of the world, anyway.
And then we have two just great teams in the Pac-12 that were ranked so well, and
Yeah.
it's no more.
I tell you, I think they're going to move Christmas on us next.
Well, yeah, what's the world coming to?
Anyway, Bruce, as long as we have you and your X and O's, I really want to thank you for, coming here and sharing your great work with our community. And,
Well, it's always a pleasure to be with you all.
Happy holidays to you, and I'm a
Happy
fan.
holidays to everybody, and
I'm
thank
a
you
fan.
much.
So my trading warrior brother, Bruce Fraser, best place to follow you. There you go.
There you go. So a lot of free stuff at Wyckoff Analytix. If you have any interest at all in Wyckoff, it's a good place to go to learn more. And also Roman, my teaching partner, and I do a weekly series, Wyckoff on the markets. And so you might enjoy checking that out sometime. Every so often we do a free one. The October one is right there for viewing. You can just check a little bit of that out. But Wyckoff Analytix, a lot of free content.
Well, Merry Christmas, Happy New Year, Bruce. I hope that
Thank you,
tips
Merry
rain down
Christmas.
on you and your subscribers and your partner, and that you
Thank
have peace and health with you and your family.
Well, and to you all also.
All right, Bruce Fraser,
Thank you,
everybody.
Dale. Take
Great
care,
having
everyone.
you, Bruce. I'll be in touch, buddy.
Okay. Be good.
All right.
Bye-bye.
So check out Bruce. Should be part of your intelligence gathering, and you could join the team in 17 minutes on the morning edge. That's a wrap for me. Don't just count your X's and O's, count your blessings, and I'll see everyone tomorrow for Turnaround Tuesday. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.